I'm 39 years old, and if there's one thing I've learned about money, it's that numbers on a screen tell less than half the story. We all look at charts, right? We see lines going up, lines going down. We think it's all about analytics, earnings reports, and economic forecasts. And for years, that's exactly what I believed. I thought if I just did enough research, read enough articles, and understood the fundamentals, I could predict where the market was going. But the market isn't a machine, it's a crowd. And crowds are driven by emotion. When I first started trading in my late 20s, I was a classic case of overconfidence. I had a bit of savings, a decent job, and I'd read a few popular investing books. I felt like I had an edge. My strategy was simple: buy what's hot. A new tech stock everyone was buzzing about, I was in. A cryptocurrency that promised to change the world overnight. Sign me up. For a while, it actually worked. I saw my small account grow, and with every green day, my conviction grew stronger. I wasn't just investing, I was winning. I felt smart, like I'd cracked a code that others couldn't see. My daily routine became a cycle of adrenaline. I wake up and immediately check my portfolio. A good morning meant the day started with a rush of excitement. A bad morning meant a cloud of anxiety followed me to work. I wasn't making decisions based on a long-term plan. I was reacting. A stock would dip 5%, and panic would set in. Should I sell? Is this the start of a crash? I'd sell, only to watch it rebound the next day. Then, FOMO, the fear of missing out, would kick in. I'd see another stock soaring, and I'd jump in at the peak, terrified of being left behind. I was buying high out of greed and selling low out of fear. I was a textbook example of what not to do. The accumulated consequences of this emotional trading weren't just financial. Yes, my portfolio was a chaotic mess of small wins and significant, gut-wrenching losses. Over a few years, I had essentially gone nowhere, churning my account and paying fees, all while the broader market was steadily climbing. But the real cost was my peace of mind. My mood was tied to the market's whims. Conversations with friends would drift back to stocks. I lost sleep. I was constantly distracted, checking my phone during dinner and meetings, even when I was supposed to be relaxing. My financial journey wasn't about building wealth anymore, it was an addiction to the highs and lows. The turning point wasn't a single, dramatic event. It was more like a slow, painful awakening. It came after a particularly brutal week where a speculative bet I'd made went completely sideways. I had ignored all the red flags, convinced I was smarter than the market. I lost an amount that, for me at the time, was devastating. It wasn't just the money. It was the crushing realization that my entire approach was wrong. I sat there, looking at my account balance, and for the first time, I didn't feel anger or panic. I just felt tired. Tired of the constant stress, the guessing, the emotional roller coaster. In that moment of quiet defeat, I finally understood. The market wasn't my opponent. My own emotions were. Greed had pushed me to take reckless risks. Fear had caused me to sell at the worst possible times. Hope had kept me holding on to losing positions, praying for a recovery that never came. All the technical analysis in the world couldn't save me from myself. The price action I was seeing on the charts wasn't just data. It was a visual representation of collective human psychology. The steep climbs are collective euphoria. The sharp drops are mass panic. The market moves because millions of people are making decisions based on the same emotions I was wrestling with. What can't be reclaimed from that period is the time. Not just the years of stagnant growth in my portfolio, but the mental energy I wasted. The hours spent staring at charts, the sleepless nights, the anxiety that bled into every other part of my life. That's the cost you can't calculate. I missed out on the simple, boring power of compound interest that would have come from a steady, unemotional strategy. While I was busy chasing quick wins, the real wealth was being built slowly, quietly, in the background, by people who weren't trying to outsmart the market, but simply participate in it. So if there's anything I wish I knew back then, it's this. Mastering your emotions is the most critical skill in investing. Before you learn about P/E ratios or support and resistance levels, you have to learn about your own tolerance for risk, your own tendencies toward greed and fear. You have to build a system for yourself, a set of rules that you follow no matter what. For me, that meant stepping back from individual stock picking for a while. It meant automating my investments into low-cost index funds. It meant setting a plan and sticking to it, whether the market was soaring or crashing. It's about separating the decision-making process from the emotional outcome. You make your plan when you are calm and rational, then, when the market gets chaotic and your instincts are screaming at you to do something, you trust a plan. You trust a version of you that wasn't acting out of panic or euphoria. Today, my approach is completely different. I still follow the markets, but I'm a spectator, not a participant in the daily drama. I invest for the long term, and I accept that volatility is the price of admission for long-term returns. My financial life is no longer a source of stress but a tool for building the future I want. And that peace of mind? That's a return you'll never find on a stock chart. Trading psychology isn't some advanced topic for the pros, it's the foundation of everything. Learn to manage yourself before you ever try to manage your money. Thanks for listening to my story. I hope it helps you on your own journey. If it did, maybe consider subscribing for more reflections like this. Take care.